Hey, good afternoon. Inflation data has come in very hot ahead of the Fed decision. So we're going to break down some of the CPI, PPI data here this week, and also address a great question of the week about basically what options are available for business owners to look at deferring savings, exploring tax planning strategies, and increasing their retirement. My name is Brandon Steele, financial advisor with Mainsail Financial Group. And our goal every Thursday is to bring to you the market news, the data, the trends that we're watching, and hopefully weed out some of the noise along the way. So I feel like I have teed this up plenty at this point. But yes, this week, today will definitely be a lot about inflation, and we're going to start right there. So here we are on Thursday, and just yesterday and today, we have had a lot of data come out between CPI and PPI, again, consumer and producer price indexes. And this is the last kind of inflation data point ahead of the Fed meeting next week. So there is a lot of weight to put on this report as we gear up for the Fed's decision. So yesterday was consumer price index data. CPI data came out, and CPI itself, the headline number, was up 0.6% for the month. Let that sink in for a minute. 0.6% for the month. Right, so it was a big increase for sure. Now, keep in mind, again, the headline data does include things like food and things like energy. So as oil goes up, for instance, this number can go up significantly, same with food, which both of those areas are a little more volatile. So we have heard the Fed talk mostly about core CPI, which strips out those two areas. And even core CPI was up 0.3% for the month. So again, this was higher than expected as well. I think most of the street, so to speak, was expecting 0.2% for this month. And again, CPI came out 0.6%. Core CPI was ahead of those expectations at 0.3%. And this brings year over year core CPI to 4.3%. So obviously, we've been talking a lot about the Fed's target of 2. We're nowhere near that by any means. And yesterday in the markets, they basically all but shrugged this off. I mean, markets were almost flat, maybe slightly up, slightly down, depending on which index you were looking at, but basically shrugged off this whole thing, even with, the potential threat of the Fed meeting coming up next week. Today, we had PPI data come out, and if CPI surprised people, I think PPI did even more. Producer price index is what this stands for, and it was up much, much more than expected. Now, that said, I think most people focus more on the consumer side of things. Obviously, that's what we all feel. As you might imagine, if the consumer is a little strained in terms of cash flow, that's where challenges can come up more broadly in the economy. So the CPI data is, I think, a little more heavily weighted in terms of how people view the markets. But nonetheless, PPI came up much, much higher than expected. And even CPI itself, again, the headline number basically in line with expectations, but a high month. And then core CPI came out slightly higher than expected as well. So, obviously inflation is still here. I think that, for those who do listen to us weekly, we've been sharing our view on this, that inflation is not going to go away anytime soon for a while. And although we are, likely starting to see it come down, I think it's more of a result of the money supply than anything else. And even so, it's very likely we still have a period of higher inflation. Now, not what we saw as we look back the last 12 months and go back a little ways. I don't expect that rate of inflation to continue, but I think it's very likely that we see a period of some higher inflation than we're used to, and possibly certainly higher than the 2% target of the Fed. Retail sales were up 0.6%, so this was much higher than expected as well. Keep in mind with retail sales, though, that the inflation data can factor into there in some degree. So, keep that in mind as we look at that data. But nonetheless, consumer from this data point anyway, certainly still seems to be strong. And coming up next week, I am just going to sum it up in one word or 2 words, which is the Fed. So definitely tune in next Thursday. On Wednesday, we get the Fed decision and press conference. So on Thursday next week, we'll be breaking down everything as far as what they had shared, and more importantly, helping to read between the lines a little bit on what Fed Chair Powell shares after the decision. Before we get there, We have a really good question of the week, which is what retirement account options are available to any self-employed or business owner individuals, and how can they use these to really maximize savings and reduce taxes to some degree? So this is a really good question, because as a business owner or as a self-employed individual, you open yourself up to a lot more options out there than somebody who is maybe on a W-2 salary or has a company 401k that they can plug into and or an IRA. So I'm going to skip that part of it. I'm going to skip the traditional IRAs, Roth IRAs, that side of it, and just spend a little more time on the more nuanced plans that you can establish as either self-employed or business owner. And I'll start with the traditional 401k. Of course, this is always an option. The reason that so many companies have 401ks is because it allows for employee and employer contributions, but most importantly is it allows the most flexibility. Outside of that, we've got two maybe more simple, I guess that's a little bit of a hint, simple types of options available, because the challenge with 401ks is that there's a lot of accounting, a lot of things to manage, a lot of things to watch. And so if you are a smaller business owner, there might be some other options available to you as well. The first is what's called a SEP IRA. And this really is generally for either, much smaller firms or businesses with just maybe, owner employees. And the reason I share that is because with a SEP IRA, the contributions are all from the employer. So if you are an employer and you are hoping to contribute the max that you can to your plan, you also have to do that for every employee you might have. That might be totally fine, but especially if you're maybe older employer and you're looking to contribute as much as you can, you also have to do that for every employee to the same degree, all right? So this is generally a really good opportunity for somebody who is either self-employed, or again, it's more smaller firm and or just more, owner employees within the firm itself, because it has really high limits as well. You're able to put quite a bit away into this plan. Next this was the hint, is a simple IRA. So this starts to feel a little bit more like a 401k, but this is a simpler version for employer groups under 100 employees. All right. So the benefit here is that it's not just employer contributions. Now you open up employer and employee contributions. So you can start to add matches. You can start to contribute more to your own as an employer than you might for your employees, and reward their contributions as well through some sort of matching program, something along those lines. But again, it is for employers with under 100 employees. And as the name kind of suggests, it is much simpler to manage, much simpler to maintain, because basically each employee opens up their own IRA rather than a 401k as the whole group. Okay. We touched on 401ks. The last one I will touch on is pension plans. And this might sound really strange. We all know that pensions, at least for big companies, have certainly started to disappear to some degree, or at least are, maybe being phased out. But maybe as an individual business owner, or as an older business owner who maybe has younger employees, a pension plan can be a great way to get a ton of money into a retirement plan, especially later on in life. Because of the way pension formulas work, generally, if you are older, you may be able to contribute a giant amount for your older employees, or yourself, if that's you, if that fits into your demographic. And then if you have younger employees, you still are contributing, but maybe at a lesser degree. So whether you are a self-employed individual or, again, maybe an older business owner with younger employees, this type of plan, if used properly, can allow you to put a ton away, especially later in life. So generally SEPs are going to be for folks who have, again, smaller groups and or, just self-employed individuals or owner employees. Simples generally for groups under 100 that, aren't really looking for too much flexibility in their plan design. 401ks is where we start to allow a little more flexibility, a little more management of it too, but nonetheless more flexibility for the plan design. And then pension plans for those who really want to make giant contributions maybe later in life. However, of course, the challenge with pension plans is the flexibility. So hopefully that's helpful. Really good question, especially as we get towards year end. This is a very good time to start thinking about that. So thanks for sending that in. And thank you all, as always, for tuning in. We will see you next Thursday at 3, where we're going to be spending a lot of time on the Fed and just breaking down some of the decision and the in between the lines of the press conference to follow. Have a great upcoming weekend. We'll see you next Thursday at 3.